Hi, I'm Christine Kopr, Senior VP Sales with Sotheby's International Realty Canada in Vancouver, BC. And I'm going to do your June 2023 market update. We're going to review all the stats. Now, of course, a couple things have happened in the marketplace since June, but we're going to touch on those very quickly. Normally, I go straight to my graph that tells you exactly where the market's heading. And it's all based on months of inventory, which is a reflection of supply and demand. But first, we're going to take a look and focus on detached townhomes and condos and see how they're doing in the market, because I would say the peak of the market has been set and now we're heading into summer. So let's check it out. So what you have here are the numbers for June 2023. Detached homes, we did 848 sales in June. This is now down almost 20% from May. So you can see we had a very strong spring, as we discussed in previous sessions, and we are going to review coming up in the next slide here. But we're down 20% in sales, not surprising as we're heading into the summer. And because we've also now have clocked in 2 more interest rate increases that weren't exactly expected in the beginning of this year. However, the great news is sales is up almost 30% year over year for detached, and your benchmark price is sitting at just under 2 million. And really, we're just underneath that benchmark price of 2.1 a year ago. So month over month, we also experienced a very strong upward pressure on detached homes at 1.9% increase in pricing, but we are still down 3.2% year over year. But wow, was this a very rapid and quick recovery in our market? Now we all wonder what's going to happen next. Townhomes, we did 547 sales in June. That's down 10% from May. But sales are up almost 18% year over year, and we're sitting at a benchmark of just under $1.1 million for the Real Estate Board of Greater Vancouver. The benchmark price at the peak was 1.150, and we were up 1.5% month over month, which shows a very strong increase again, just like detached in terms of pricing, and we're only down 1% year over year. Again, recovering very well in that market. Now, condos, this is where the opportunity lies. Condo sales, we did 1573 in June. Now that's down 9% from May. Again, May is the peak market for the spring for the Real Estate Board of Greater Vancouver, typically, as before we start heading into summer and getting off onto other plans and other things. And the sales are still up 19% year over year, and your benchmark price is sitting at 767. The benchmark price was 844, and so month over month we're up 0.8%, and year over year we're up 1%. However, while this was the benchmark at the peak, our sales are now above the 10-year average, and there's a strong demand for that entry level home, which is definitely making it a lot easier for people to make that jump from the lower price band into the higher price band, where things are getting more and more unaffordable. Of course, with interest rates, everything is more unaffordable. However, the entry level homes, people have gained some equity, especially if they've been in the market for any length of time and are able to make that transition, the mobility up into higher priced or, larger homes such as townhomes or detached market. Every month, I like to review the overall stats for the Real Estate Board of Greater Vancouver, because to me, this is everything that's happening and it really tells us on where we're going. It is a review of 2023. We're going to take a look at sales, new listings, our total active listings, which are the amount of homes available for sale today, months of inventory, which is a very strong indicator of where prices are headed, and the benchmark price. So in June, we clocked in 2,988 sales. That was down 12% from the month before and up 21% year over year. Now, remember, it is a very favorable year over year calculation, but remember, the market started to become anemic last year because it was the beginning of the interest rate increases, which everyone felt was long overdue. But, until it happened, no one was really sure what was going to happen. And then I don't think the market was really prepared for having such a strong, continuous increase month over month over month over month. So back to sales, we were up 21% year over year, and we're just 8.6 below the 10-year average. And the 10-year average has been a very important indicator in the market right now to really put these numbers into context. If we're below the 10-year, we could have a very strong month, but we need to put it into context of the marketplace, because we have gone through some wild changes in the market, especially over the last 10 years. And so we need to average it out and put it into context. New listings. This is the amount of new inventory coming on every month. We've definitely been in a low inventory environment, which we're going to take a look at. And it's one of the things that is supporting current prices. We haven't had a lot of new inventory come on. And you can see in May and June, we had less than we did in May. And we're sitting around 5,300 in terms of new listings that came on the market. So that's 5.5% lower than the month before. It's up only 1.3% year over year, and it's down 3% over the 10-year average. So you can see in terms of the 10-year averages, we don't have a lot of new listings coming on the market. And a lot of that is a functionality of interest rates. And previously, potentially sellers not wanting to participate in the current market valuations that were earlier this year. Now, total active listings, this is the amount of homes available for sale today on the Real Estate Board of Greater Vancouver, which spans from Whistler all the way out to Maple Ridge. So it is just like one big pool, like the TSX Venture. It's a pool of all the stocks. They all perform a little differently. Houses, townhouses, condos, depending on the region, west side, east side, pockets that are experiencing different changes are all going to perform differently. So if you want specific information for you, please reach out to me so we can do this detailed analysis for your type of product and location. We're sitting at 9,990 listings at the end of June. So it's kind of the highest we've had this year. However, we've also had very strong sales at the latter half of this year. It's up 7.5% month over month, but it's down 7.9% year over year. Months of inventory takes these sales, the strength of the demand, the amount of people out there that want to purchase a home right now, and it divides it into the total active listings, all the product that is available for sale. And it's basically the absorption rate. And the assumption is, if this level of sales volume continued and we didn't have any new listings coming onto the market tomorrow, which would be the new listings, if we just had 9,990 homes available for sale and this demand of almost 3,000 homes per month was continuous, how quickly would we sell through all the available homes on the market? That is your months of inventory. Anything below 4 months is considered a seller's market. There is not enough inventory to satiate the demand. If you remember home prices or cars during the pandemic and the lack of available inventory, car prices were driven up. There was so much demand and prices went through the roof. Same with real estate. And when we have 6 months and above of inventory, we start to have more and more inventory accumulating on the market, and there isn't enough demand to keep it down in either a balanced or seller's market. So the more and more inventory creeps up, there's more downward pressure on pricing. Buyers have more control over the marketplace. It's a market type that every buyer wants, except for it's a blessing and a curse, because of course, prices start coming down and then buyers get concerned about they don't want to catch the falling knife. So it's an interesting thing, sellers and buyers market. Sellers markets are great for sellers. They tend to dictate more of the terms. There's less inventory, and so they can control more of the situation. However, when it's a seller's market, while it's great being a seller, sellers usually turn into buyers, and then they're faced with the same situation as well, which is having to compete, generally speaking, on the other side of buying their next home. So each market brings its own pros and cons. One is not better than the other, and a balanced market always flashes before our eyes. That one just does not hang around very often for us. As a result, we've had a benchmark price that has been increasing steadily since early January. You can see all the prices below are the benchmark. If they're in yellow, it means the price has gone up. If it was red, it means the prices were decreased. And you can see with this very rapid recovery, probably a result of the hold on interest rate increases earlier this year and buyers and consumers becoming used to the current interest rate environment and things becoming more normalized for the marketplace. Buyers got back into the marketplace, probably also anticipating that we might see some decreases in interest rates in the near-term future. As you can see, as of June, we had a benchmark price of 1.203 million. That's up 1.3% month over month and down 3.2% year over year. So remember, the year over year now is from the peak. So we're recovering very nicely. Right here is actually a review of 2022, just so you can see how things changed. You can see at the bottom here, prices, they were steadily increasing until about a year ago, which was the peak. And since then, we had decreasing prices. And as you can see, we had increase in inventory as our sales plummeted down below the 2000 level. We barely had any new listings, but that didn't save us because we definitely had a rise of inventory. You can see 10,000 compared to what we have today, slowly making its way down, which has been helping, but it's these really, really low sales that impacted our market previously. In 2022, we experienced seven interest rate increases ranging from a quarter point to half a point to a full point in July of last year. And I think that really was the one that, I mean, after the accumulation of it all, kind of nailed the market pretty hard. And then the following increases, it made for a very, very negative psychology and marketplace. And it really showed with January, as you can see, it was kind of, as a realtor on the ground, it was probably the worst time of the year. But we've had an amazing recovery. Nobody thought that it was going to recover that fast. Now, here's our 3-year amount of inventory on the Real Estate Board of Greater Vancouver. You can see slowly but surely things have tightened up. And to put that into perspective, this is our max inventory, goes back to 2005. You can see we're nowhere near anything that happened during the Great Financial Crisis, the GFC. And here we are sitting today with very low inventory environment, very similar to the heated market of 2016 and 2017. This is what happened when the stress test was introduced. That became a little bit more normal. Interest rates started to come down, and then COVID hit, and it's been a wild ride ever since. Sales, you can see here the last 5 years, basically going back to 2018. Again, this was a very anemic market, downward pressure on the market. We had very high months of inventory, and then that started to recover in 2019. And then we're starting to come out of that. I remember a COVID and the lockdown being announced. I had 140 people through an open house. And then right after that, we had lockdown, and it was the very beginning of the start of the recovery from the 2018 changes in our marketplace. And then sales just went through the roof. Everyone thought that COVID was going to break the world and it was all going to be financial ruin for all of us. But of course, all of our governments kicked in with these emergency low rates, and sales went through the roof for everybody who had not been impacted and didn't lose their jobs throughout that period, and onwards with inflation. Taking a look at the Real Estate Board of Greater Vancouver and its historic performance, you can see going back to 1977 where prices have been, where we peaked out, and we're getting so close back to those peaks. And you can see here for condos and townhomes as well, it's been a very, very resilient market. Taking a look at what's happening over BC, you can see the same thing. We had very low listings earlier on in 2022. More came out earlier as 22 continued, and we're sitting here. You can see how everybody's been recovering. Not a lot of inventory, right? Earlier this year with all those interest rate increases, there was a lot of listings. That has definitely tightened up across the board. Okanagan, Vancouver Island, the Kootenays, Lower Mainland. Sales by region, you can see, have also gone up. The Lower Mainland, a significant amount of sales, also the most amount of people, but you can see the trend. The average price by region, of course, this isn't by price point, it's indexed to 100, but you can see these strong recoveries. We having the higher average or benchmark price, we don't have as fast rapid growth as some of these other markets where prices really skyrocketed because you had a $200,000 property go to $400,000 versus a $1 million to $1.2 million property. The percentages are different because the numbers are bigger for the Lower Mainland, but you can see that the average price has recovered since earlier this year. And this is the same reflection here with the house price index, trying to compare this like cookie cutter home. Sales to listings ratio, which is like our months of inventory, but it's the absorption rate. Again, you can see this recovery here. So across the board, this is definitely happening, not just in the Lower Mainland, but across the province. There's definitely been a strong increase in rental rates throughout this period. And of course, mortgage interest rates have definitely taken a couple of increases here recently. So you can see variables are sitting as high over 6%. And in some cases, this is after the discount. You're sitting in the mid fives for a fixed rate currently, which, by the way, earlier this year, you were able to secure about 4.7 or so, 4.8 on a primary primary residence for a fixed term about January, February, which is when the psychology started to become more positive. Just a quick snapshot to show you what TDs, mortgage rates, are looking like in terms of a 3-year fixed, a 5-year fixed, and then their high ratios. So, and where prime rate is sitting today. It's pretty spectacular. Never thought we would be getting here, but it makes sense because we're experiencing severe global inflation, which, as you probably have heard, is starting to get under control. So let's talk about market drivers. And if that's the case, why did we have an increase in interest rates? First of all, we have a lot of consumer confidence right now, or we did a few months ago. Obviously, that can change just like that. It's just like the stock market. People's emotions can just change. And with 2 back-to-back interest rate increases, this can start to impact the consumer's confidence about where the housing market is going. And again, coming back to the I don't want to catch a falling knife scenario. So let's see how long buyers are going to be okay with these newer rates and how many more are we going to experience. But up until now, we've had a very strong consumer confidence. People have jobs, there's been a lot of spending, and then we saw a lot of multiple offers. And Tiff Malcolm has mentioned that our strong housing market is a part, an influencer as to the Bank of Canada deciding to increase interest rates, which is something I talked about in the past. Inflation has definitely been cooling based on their numbers, down to 3.4 from 8.1 in June of 2022. So inflation is starting to get under control. But the problem that the Bank of Canada has is a strong economic activity. There's been jobs, and jobs numbers came out. And when they came out in June, the bond market went crazy, which the bond market is the market that controls fixed interest rates, whereas the Bank of Canada and their overnight rate controls variable rates. So there was a huge spike in the bond market when the jobs market came out so strong, which basically told the bond market there is no recession coming, and it is strong out there and people are making money and they are spending it, which means there's demand for consumer goods. And when there's demand for consumer goods, prices go up. So that is the problem that the Bank of Canada is struggling with, as well as with a rising housing market. The funny part of the inflation factor, as well as it also had an uptick in June, with housing costs being a part of that uptick, which totally makes sense because, of course, they raised interest rates. So, of course, inflation also went up because they raised interest rates. So that's a funny part of this situation. The one lever that they have to control the marketplace is also one of the levers that convinces them to continue to raise interest rates. So that's a little bit bizarre. And with the latest interest rate increase, it was up another 25 basis points on July 12th. We're now sitting at a rate of 5%, which has not been seen since 2001. Wow. Where is the market going? And that's a very great question. Never a dull moment in our Vancouver market. There's definitely opportunities to be had. It's shifting. We're coming into the summer season. Interest rates are rising. Hopefully, we don't see any more interest rate increases. And if we do, maybe 1 or 2 more, because the Bank of Canada has to be very careful to not drive us into a recession. They want to probably kill some jobs and kill some spending, but they also want to avoid running us into a recession. There are going to be opportunities to be had. There are probably going to be some people who are struggling meeting their financial obligations, but so far there have been very lenient policies that have allowed anybody on a variable rate mortgage with a fixed payment to basically extend their amortizations and not actually have any of their payment go down to principal. So I think the banking regulators are hoping to drag this out a bit and let interest rates come back into some kind of a range that is acceptable, that the consumer is able to deal with, and then basically rein in some of that extended amortization. We're getting pretty technical here. Things have been very strong. It's been a very rapidly and a positive spring market. We're heading into summer. Things are cooling down a little bit, with the next busy season being in September. If you're thinking about buying or selling, please make sure to reach out to us so we can help you navigate all of these changes that are occurring on a day-to-day basis. And if you haven't seen my latest listing, I encourage you to check it out because it is very special. We just listed a 2,000 square foot townhouse on the seawall of Vancouver, steps to Granville Island. It's a very special property because it's the size of a house, but it provides all the conveniences of condo living and resort amenities. It's a 2-bedroom with a potential 3rd bedroom, 3-bath property that has one of the most extensive and full renovations I've seen. Please reach out to me to learn more. And with that, I'm Christine Kopr with Sotheby's Realty in Vancouver, BC, and I look forward to connecting with you. Take care.